Hi traders, welcome to this edition of Market Outlook. Trends, risk events and trade setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and trading opportunities in the markets currently. Whilst I'll just let you have a look at the disclaimer, I'll just run through what we hope to go through this week. Firstly, obviously, we'll follow the usual format actually, so check out where markets are currently and certainly look at in more detail last week's price action in the US stock markets and in the dollar as well. Massive moves there on the back of course, the US CPI data. We'll look at that in more detail as well, as certainly that was a huge driver of markets last week and potentially going into this week as well. There's kind of been a positive feedback loop, which we'll talk about at the start, actually in a few minutes, just with the China news, of course, a positive China news potentially on the relaxation of the COVID measures, potentially in the reopening then. But also, of course, the market reaction to the US CPI data has been historic, really. So we'll dive into that. We'll look at the numbers in detail on the US CPI report, and then we'll look at how gold price action was affected by that and what we see going forward, as well as in euro dollar. And then we'll hopefully wrap up with a look at the UK this week in focus, lots of data out here, and also the fiscal statement, which will be on Thursday, announced by the new Chancellor, Jeremy Hunt, in the UK on Thursday. So potential impact from that, probably more longer term, unless he very much disappoints the markets and sort of that credibility that has been won back slightly, if that is sort of repealed by his contractionary budget, which is set to be announced. That is on Thursday. Okay, let's get straight to it. Let's look at markets currently. We pulled up this chart actually a few weeks ago for some of you who were on that call, on that webinar. And we kind of marked out, middle of October actually, so a few weeks ago, just the sort of seasonality aspect of US stocks coming into year end, that supposed Santa rally. And you can see it is kind of a phenomena, if you like, and something that some of us were talking about a few weeks ago. Obviously, certainly before then, we had the massive rally last week. So something to bear in mind, of course, added to the other drivers currently that we see. A wild ride really in stock markets last week, as I've said. US futures at the moment slightly off, which is kind of today, which is kind of natural after such a massive move, really, it has to be said. I've just pulled up the S&P chart here, but as I said, it's kind of this positive feedback loop, if you like. We've had, and how long this is going to last. So we've had obviously this US inflation data lower, we've had China reopening, and then we've had also this potential war de-escalation in Ukraine. Sentiments checked slightly in Asia, but China released this 16-point plan to support the beleaguered property sector, as well as a 20-point plan for reducing the economic costs of containing COVID. These moves really clearly provides some further support to China's economy, though certainly we have to factor in rising COVID case numbers, which are being seen across the country still. It's kind of probably more relevant, these pointers, these two plans, especially more relevant for the medium-term outlook, but certainly an encouraging development, and as well, further supported changes can't be ruled out. Equities, they've been on fire. So the global MSCI World Index, that was up 6.7% last week. The S&P added 5.9%, the biggest increase since June, and the tech-heavy Nasdaq that increased over 8% actually last week, and that's the most since March. So rate-sensitive stocks and China-sensitive plays as well, they've rocketed. And if you consider that on Thursday, we saw $1.7 trillion added to the market cap of the S&P 500. That's the third highest amount ever, I understand. And while much of this was short covering and position readjustment, certainly there's a lot of cash on the sidelines from fund managers, still fairly short on risk assets, certainly on equities as well. And they're looking at the market really kind of fearful of a further melt up, this idea of not a meltdown, but a melt up into, and as I've just shown you, a seasonally quite a strong period. We'll get into some of that detail on the fundamental side actually after the CPI report, when we look at that briefly shortly. But certainly in the near term, kind of tempering slightly this positivity. We had some Fed comments over the weekend. Fed's Waller actually warned that the Fed may consider slowing the pace of rate increases at its next meeting, so that's great. But then it should not be seen as a softening in its commitment, the Fed's commitment, that is, to lower inflation. And we highlighted this in our week ahead preview, actually, over the weekend, about the number of Fed speakers really to note. I think there's around 14 scheduled for this week. And the highlight really is probably Brainard on Tuesday. She discusses economic policy, but is one of the most dovish Fed officials out there. And apparently was behind some of this dovish statement language that we saw at the November Fed meeting. And real expectations, actually interesting expectations that a lot of these Fed officials will continue probably this push back against the idea of the Fed pausing, really. They don't want to signal, policymakers that is, don't want to signal as yet that kind of pullback, as that really will reinforce a loosening of financial conditions that could undermine certainly all the hard work in trying to constrain inflation. So we kind of think there should be some or more hawkish rhetoric actually over the coming few days, messaging that while there are likely to be this moderation in the size of rate hikes, certainly inflation is not defeated, and there is likely to be a higher terminal rate, a higher peak rate, that is, than certainly the one the Fed has signaled back in September, which you remember was 4.6%, I think, the average of the dots. And certainly Fed Chair Powell did point out that that would probably go higher. So we'll see that in a few weeks in December, the start of December, at the next Fed meeting, the final one of the year. For stocks then, S&P, we've seen a massive bounce actually from the lows, over 14% from the lows, but we're still down around 15, 16%, I think, for this year still. But the lows certainly big bounce from sort of 3,500. If we look at the technicals now, you can see that move higher, sort of corrected slightly back to sort of 3,750 or so, but certainly been an impressive move in the S&P, and now closing in on the psychological 4,000 level, which is also, then you can see we've got some fib levels on here. That's also the 61.8 fib level of this down move from the August high. That's just above 4,000, so a couple of levels there. Obviously 4,000 level generally just a psychological marker, if you like. If we do get above there and we're not overbought, you can see on the RSI, this daily RSI, then we get the widely watched 200-day moving average. That's at 4,081. You can see the thick black line there. Cap prices in August, and sort of acted as a sort of resistance level after a bit of a breakout above in March. You can see March, late March, early April, capped those prices, and then we came back. So interesting, if we do get up to there above 4,000, 4,081 or so, the reaction then, if this bullish momentum can continue. The NASDAQ, we look at the NASDAQ 100, again, a decent move off the lows, around 13%, I think, from the October lows. From here, you can see, and really now we're getting up to the 50% marker, also the midpoint of this August fall. That's at just above 12,000, 12,080. And then you also have the 100-day moving average. That's this sort of dark gray line just below the 12,000 level there, 11,986. So sort of levels for targets for the bulls to look at, sort of corresponds with that 21st of September high there, just above 12,000. The 200-day moving average much higher, 12,732. You can see there. Okay, let me just check, sorry, with what you guys are looking at. My apologies. Hopefully you can see what I'm looking at now. So let's just go back, actually, if you like, to the S&P 500. Hopefully, thanks for that comment, Joy. Yes, you can see it now. Good. Apologies for that. Technical issue. So the S&P, you can see here, if I just run through very briefly, this big bounce, over 14% from these October lows, around 3,500. Just below that, the low 34.91. Then we've had this decent bounce, pull back slightly to 3,750, and then the move higher again. The massive move, of course, on Thursday that I've outlined, and then even interesting, really, because a lot of us kind of who've seen these strong moves, especially on one day, you kind of think there will be some kind of consolidation, but certainly on Friday, even though it was a bank holiday in the bond markets, Friday we had another push higher as well. So fascinating, really, this sort of squeeze in positioning. As I've mentioned, a lot of fund managers still quite short equities, a lot of cash on the sidelines, as I've said, and that has got to go to work somewhere, especially as we come into year end. And I'll touch upon this, really, but it's kind of FOMO coming back into play slightly, the fear of missing out. Fund managers can't be short if they're missing out on performance coming into year end, when certainly they're assessed on their kind of performance across the year. So interesting, the squeeze really higher, and then you've got these other factors as well, as I've mentioned, China, and also this possible de-escalation in the Ukraine conflict. But yeah, 200-day moving average, that is always widely watched at 4,081. You can see just above, if we do get momentum, and as I highlighted on that RSI, this line here, this chart, this indicator, we're not overbought as yet. 61.96 there, you can see. Overbought territory is normally around 70, which is that dotted mark. And you can see in August where we got to that, plus the 200-day moving average, then we fell back, obviously sharply. So interesting, if we do get above 4,000, then what happens into that point, really, and if we do get overbought on the RSI. The NASDAQ 100, I mentioned, 200-day moving average much higher. Really, we've got the 100-day moving average before that and around the 12,000 level, which is the halfway point of this August downtrend. I probably was going to look at the Dow as well. You can see here, obviously, we've highlighted the last couple of weeks now, just this outperformance of the old economy stocks, if you like, value-based stocks. And then really that's what we are hinting at last week, in fact, when we just sort of highlighted that difference, but also that it was becoming quite extended. And certainly then last week you had the outperformance of the NASDAQ, the tech-heavy NASDAQ, that is, compared to the Dow. The Dow It is up 18% from these lows. I think I mentioned that last week, sort of getting close towards that 20% bull market territory. But we're up around 18% or so far, I think, from these lows. And really critical then, if we do carry on, you can see we're slightly overbought then on the RSI. We did have that nice sort of pullback from the overbought territory there. And then we've obviously gone again, but we're sort of touching, well, 68, so touching again near 70. You can again see that working quite well in August, overbought territory, and then we came off there. Let's just see the last overbought time. Okay, was back in November last year. You can see where we went to, around 72 or so, probably on the RSI, and then we came off sharply. So kind of one indicator probably amongst many, hopefully that you guys look at, but I've just left it there. But the August high then is at 34,281. If we do carry on, be interesting to see what happens around that marker, just around 34,000 really. After this real strong move, and we would then get into bull market territory. That would be above the sort of 20% marker from those late September lows really, that we've moved up from. I'll just actually look at one other index we've been looking at, the DAX, massive move on Thursday, and broke really through that 200-day moving average at 13,580 there in the DAX. And also then, well, I've got the halfway point actually of the this year's move. You can see on the weekly chart here, I've just switched to that weekly chart, and you can see the halfway point from the downtrend of this year actually is at 14,051 there. So we broke through that on Thursday, and again we've sort of carried on going, although today we've sort of got slight consolidation, really only natural after such a strong burst higher. So levels above here, then we've got the June high, 14,741. This is in the DAX, the German index. If you look at that, potentially, if we do push higher, but you can see on the RSI, we are overbought now at 73 or so above that. Let's just go back to the time we were sort of at that same level again in November, where we fell off quite sharply. So interesting levels to look out for in some of these stock indices in the US and in Germany after such strong moves. For the dollar, of course, that took the opposite turn really. You can see today we're sort of pushing up and trying to pick up the pieces really after the massive sell-off last week. DXY plunged 1.7% on Friday, I think. Weekly losses of around 4%, so massive, real big losses in the dollar. A trigger, of course, the US CPI data, and then the size of the correction really is down to position adjustment really and dollar ownership. I think that was described as the most crowded trade in the global investment community, that is being long dollars. So really the question then, how long does this last? We've sort of got this rebound, you can see this morning and today. But remember, of course, for us, the Fed is still tightening. So it still has work to go. And also then 2023 world growth forecasts, they're still being cut. And in fact, the IMF warned, I think, over the weekend about even lower global growth than the downward revision to 2.7% it made in its outlook last month. So certainly we think markets should bear this in mind, but of course you do have those other factors around position readjustment in equities. But for the dollar, yeah, technically then we've got the dotted line here, 105.78. This is on the DXY, this basket of 6 major currencies. against the dollar. We've got, well, the June peak still in there, 105.78, as I say, but we've bounced ahead of that actually. So really resistance will come at 109, just above there. That's the 100-day moving average. And then sort of that long-term dotted line, you can see hopefully that trend line, upward trend line really, which has acted as support, but will then of course act as resistance if we do get into that around sort of 109, 110 level there, for any more upside in the dollar. Okay, let's look at the CPI now. Hopefully you can see the slide here. First of all, just a sort of summary of the US CPI data from last week, 7.7%. Really overall though, a much better report. Everybody was hoping for this. The market was desperately hoping for it. So the figures really much better than the month before, better than expected as well. And certainly some of the sort of more in-depth statistical measures do suggest that we're now seeing a peak in inflation. And certainly unlike several previous false dawns that we may have seen, this hopefully will not prove to be too misleading. So a peak in inflation, but really for us still elevated. You can see, yeah, from the graphic really, year-on-year inflation, so that dipped to 7.7% from 8.2%, lower than the 8% expected. That was the smallest 12-month increase since January. And crucially, really, the core measure, so that excludes the highly variable prices of food and fuel, that also fell below estimates to 6.3% from 6.6% in September, 6.5% forecast. So again, the sort of alarming and almost constant increases that have started early last year really, hopefully, probably have ended with this cold, hard data. And if we just pull up this chart here, you can see the blue line is the headline rate, the white line, the core rate, but you can see definite sort of turning down from those levels above 8%, near 9%. In the headline, and then the core, certainly, although we have seen this a turn down before, of course, let's not forget that, but potentially a top in the core as well as that turned down, still above 6% though, so something to bear in mind. Just another chart actually on this CPI data. Don't want to get too much in depth into it, but just highlighting sort of some of the key points really from it. Really noticeable, really positive surprise in the positive direction, especially after quite a few really horrible big negative surprises. And you can see on this bar chart this year, I'm focusing on really, you can see these negative positive surprises for markets. So they're negative for markets, but obviously positive surprises as in upside surprises in the headline figures. And you can see a number of those this year, and then only a couple. But then the third one, obviously this time around last week, and the biggest since those pandemic numbers really from March 2020. A final point really from all of this data really is this sort of handoff from goods inflation. We've talked about this before, to services inflation. That sort of continues as well. The initial burst of inflation last year, if we think about that, was driven by goods prices as the pandemic forced consumers to divert spending away from services. And now goods inflation is falling, which is certainly a necessary but kind of not sufficient condition for bringing overall inflation under control. Services inflation, that is still high actually, but at least it's sort of ticked down slightly, and in the current context that is encouraging. But for markets then, certainly we got this major repricing. I'm just pulling up here now a website we go to a lot. It's the CME Fed Watch tool. So shows you really a Fed funds pricing in the futures, what futures markets are expecting at certain Fed meetings. You can see the 14th of December meeting there. And then each meeting going out for next year. And it's what markets are expecting at that meeting at this point in time. But post the CPI data, we got an instant shift really in expectations for the Federal Reserve for future monetary policy. Government bond prices, they shot higher, and that's in turn hammered bond yields. The yield on the 2-year US Treasury yield, that is the one that most tracks the Fed funds. That fell some 25 pips, actually, a quarter of a percentage point on the day, actually post the CPI data. That was its largest drop since October 2008, in fact. And the degree really to which traders have or had this confidence really that the Fed won't take rates above 5%. That peak rate was around 5.25%. And that we will loosen aggressively by the end of next year. Really, that confidence was quite stark and seen in that falling in that 2-year Treasury yield, really. As I say, the peak rate in Fed funds was around 5.25% in May. And let's just pull up, actually, now you can see on this bar chart and actually below a sort of 5.25 rate. That was priced at around 31% or so a week ago, and now that's fallen back to 11% really. And as markets really price in sort of 5% and lower, 4.75% priced, the chances of that around 40% now, and that's sort of over doubled from last week, where you can see sort of 18% chances. And really back to a month ago now, you can see where we're pricing in, I think, rates actually higher than, well, between that band of 4.75% to 5%, sort of towards the higher end of that, around 4.9%, I think, last time I looked earlier today, but certainly well above the 5.25% marker that was seen in peak rates in the peak Fed funds rate in April, May, June of this year. We have to bear in mind this pricing goes to the exact point of the Fed meeting, the FOMC meeting, which is at the start of May, the 3rd of May. But then the peak rate will probably move around that date, not specifically be at that date, but maybe around that date, which is something to bear in mind. But you can just see then the big reaction and the big pullback in Fed expectations. And the question really for many is certainly how or whether the market has gone too far in this direction. And certainly for inflation, we noted actually in our daily commentary after the release that the services less energy subcomponent is still averaging 0.6% over the last 6 months. On an annualized basis, that's 7.4%. So it's certainly still high. And then also add to this that the labor market remains tight, and that means wage growth, well, it picked up in October, but it's still fairly high as well. And then if we just look at this sort of this rally in bonds, and obviously then the rally in bonds means the fall in yields in history, then just to sort of highlight, really showcase how big these moves were last week. Looking at the 10 days over the last 3 decades in which the 5-year Treasury yield fell the most, all the other bond market rallies to make the top 10 actually happened either on days when the Fed took the market by surprise with monetary policy announcement, or in response to awful, terrible news. So the October CPI number has prompted more buying of treasuries than it did during the 9/11 terrorist attacks, for example. And also another point, when Greenspan, the Fed's Greenspan, surprising intermediate rate cut in response to the collapse of a massive fund in 1998. The reaction last week was actually bigger than those two occasions. So something to bear in mind. The 5 days actually that saw the bigger falls are all essentially landmarks in financial history. For example, like the bankruptcy of Lehman's in 2008. So just highlighting really these massive moves in the bond markets, and then obviously corresponding moves in the dollar, and then this jump up in risk assets in stock markets as well. Just bearing in mind, or just looking at stocks, then I've sort of highlighted some of those moves sort of on the week. The Nasdaq on the day it gained 7.5%. That was only the fifth time actually it's managed to do that in the last 20 years. Two of the others were dead cat bounces after Lehman, so in 2008, and then two happened amid the coronavirus pandemic and sort of the chaos in March 2020. And also with the broader S&P, actually, that gained 5.5%. We've touched upon that already, but stripping out the volatility again during the pandemic in spring 2020, that was actually the biggest daily rally, the biggest one-day rally in more than a decade, one of the biggest ever. So going forward, it's notable, I think, long-term, a couple of US investment banks have come out this morning, Goldman Sachs and Morgan Stanley, basically noting or expecting a significant decline in inflation next year. Goldman's, I think they highlight three reasons why: an easing in supply chain constraints, a peak in shelter inflation. We've highlighted that over the last few weeks as that being so sticky. It's a laggard, but shelter inflation, really, if that does come down, then certainly headline CPI will come down quickly. And then the final point, Goldman Sachs also notices they expect some slower wage growth. This is next year, let's point out. So then their forecast for core PCE, so that's the Fed's favored measure of inflation, they see that falling to 2.9% by the end of next year, December 2023, from 5.1% currently. So a near halving in that rate of the core PCE. That's probably longer term for inflation. Near term, certainly just point out it's just one data point. It's not guaranteed to push down the Fed's endpoint in rate rises. And such market moves are often to do with positioning, like we've said. And again, fund managers have been holding more cash. Actually, probably should have highlighted this before. I did highlight it, that there was a lot of cash on the sidelines. But according to the Bank of America, fund managers are holding more cash than at any point since 2001. So over 20 years, really, that's massive amounts of cash on the sidelines, and that certainly gives them firepower to deploy that into year end, especially. But yeah, no doubt it's a euphoric reaction, and again, sort of reinforces potentially this FOMO idea, fear of missing out. Interestingly, I think somebody's come up with a slightly different acronym, not FOMO, FOMU, which is the fear of materially underperforming. And that's kind of what I've touched on earlier. As we move into year end, the seasonality issue potentially boosting stocks as fund managers really have to watch their performance over the whole year, in total. So in a way, the pain trade is for higher moves as positioning readjusts to that potential move. Okay, I think we'll just look at gold actually, which is here, sorry. Obviously a popular favorite trade is gold. That climbed actually 0.9% on Friday to 1771 or so. I think the highs, gold had the biggest weekly gain since March of this year. So obviously down to the softer US CPI data and then the sharp dollar decline as well. Really, those two key factors in this bounce higher that we've seen from the lows at 14 or so. Also, I think something else that's being highlighted is the underlying improvement in sentiment from the recently published gold demand trends of the third quarter 2022. That was the update from the World Gold Council. And that outlines really how central bank demand reached a quarterly record of nearly 410 tons, which was kind of offsetting the outflows from bullion-backed ETFs. And today, well, we're seeing a slight pushback actually, or a pullback really, I should say, obviously in gold as the dollar is bouncing, and certainly after those Fed comments, which will be something to watch going forward this week, we think. And then previously we've mentioned around this whole idea of peak Fed hawkishness, if you like, and also the China story as well affecting gold potentially. And that was obviously, we highlighted before, the longest losing streak in gold going back to the 1960s, actually 7 months of declines. And really we sort of highlighted the risk reward potential, if you like, of a rebound. Interestingly, ETF investors, they've been net sellers for months really, and speculators as well in futures markets actually. They are probably the key to more upside. We've had this pullback, you can see today, off around 0.8% or so, just 0.79% actually, from those highs at 1772, actually the high. If we do move above here, then you can see the upside potential up to the 200-day moving average around 1803. And then you've got these August highs to take note of, 1807, I think. And then where are we? 1802. So 1800, certainly a big level to the upside for the bulls. I've kept in here this sort of long-term bearish channel that you can see there, and then the breakout obviously, which corresponded with the 1676 sort of zone. But a really nice breakout from there, then some consolidation, then a breakout, another push higher, which we said is sort of rare, but we've got up to overbought territory on the RSI now, and so naturally we get this pullback that we sort of highlighted before. If we do come back, then you've got support then at the 100-day moving average at 1714, kind of tallying with the October highs around 1727 or so. I know some people are highlighting 1735, so the September, sort of mid-September highs as the first level, initial level of support in gold. How are we doing for time? I think we should move on probably to the UK, if that's good for you guys. Let me just pull up a chart firstly. Yeah, so UK, a lot of data out this week. Probably the major one is US CPI data. Just before we get that on Wednesday, we also get the jobs numbers. On Tuesday, tomorrow, expectations for unemployment to stick at 3.5%. So really, you've got to think, despite all the recession talk in the UK or around the UK, there's kind of little to no sign really of increased redundancies so far, and firms continue to face kind of material staff shortages really. Wage growth, that's likely to remain strong due to the tight labour market and also the lack of let up in inflation. And these numbers probably looked at, really, that probably reinforces the Bank of England's views that it's too early to pause rate hikes for now. If we go back to the November forecast by the Bank of England, unemployment was set to rise to 5% in 2023 and 6.5% in 2025, so much further out. But obviously, any signs of softening in the labour market could see some bets for more rate hikes by the Bank of England pull back, actually. But maybe not a market move as such, if we stick to the sort of estimates. But then we get the Wednesday inflation numbers. Expectations are for a year-on-year rise to 10.8%, near 11%. And that's from 10.1% in the previous reading. That was the highest in 40 years. And you can just see the chart here, obviously, just this parabolic rise, if you like, from sort of below 2%, if you remember, is the Bank of England target. And so below there, and then up to near 11% expected on Wednesday. The data will include the latest rise in electricity, gas prices, but given they're now being fixed by the government until at least April, their contribution may now have peaked, actually, although there will be a lot of uncertainty, certainly around this April idea and what happens after that. But still, headline inflation, that's unlikely to slip back into single digits until probably May or April next year. And as a reminder, again, the MPC, the Bank of England, currently projects actually CPI starts to fall back from early next year, as previous increases in energy prices drop out of the annual comparison. So that's those base effects really potentially dropping. And then domestic inflationary pressures, they remain strong in coming quarters, but then subside. I think CPI inflation is projected to then fall sharply to some way below the 2% target in 2 years' time. This is based on the MPC forecasts, and then further below target in 3 years' time. I think really interesting, another prominent investment bank, I think it might be Morgan Stanley, actually today has come out saying that they don't see the Bank of England's they see them stopping raising rate, not raising rates in 2023, actually, or halting rates in 2023, the hike in rates, sorry, and then they see 150 basis points of cuts coming in 2024, so 1.5% or so of cuts coming the year after next. We get retail sales figures as well on Friday. They're expected to show the third straight month-on-month fall in sales, really, as the cost of living crisis squeeze continues to bite. That's in UK retail sales on Friday. And then in amongst this, we get this autumn statement by Chancellor Jeremy Hunt on Thursday. Both him and really Prime Minister Sunak, they need to find savings, I think, of around 30 billion to 40 billion a year. That's to convince the Independent Office for Budget Responsibility, that's the OBR, really that debt won't rise across the medium term as a percentage of GDP. Certainly no easy task. But really, it's the only way for the UK to win back investor confidence, really cement that confidence, which has been regained after the disastrous mini budget presented in September. Otherwise, we then trigger really, we would see a sharp, very sharp round, another round of sterling selling. But really, what does it mean? Well, it means tax rises for all and a big cut in government spending in the UK. And then further out, it's likely to deepen the UK recession with this grim outlook for the next 2 years, especially. The Bank of England reminding us really what they said. They expect the UK to be in recession from the middle of this year all the way through to mid-2024. And then growth will pick up only very modestly. I think they're an annualized rate of even below 1%, then 0.75%, 2024. And potentially then the 2023 budget will also potentially make things difficult as well for the economy to rebound strongly. Briefly, we'll just look at cable. That's sterling against the dollar. Sort of ignoring domestic growth concerns for sure. Sterling sort of acting as a risk gauge, really, a risk barometer, if you like. Interest rates having less of an impact, the domestic idea having less of an impact, and more is just equity markets in general and the dollar dynamics driving sterling, certainly against the dollar. And in cable, really, again, similar to the other majors, a continued short squeeze, obviously from these lows, but again, sort of from the early November lows, even around 111.50 or so, you can see those lows, and we've had a decent bounce up through 114.09, which we still got on there. The pandemic low hovered around there and around these simple day moving averages, the 50-day and the 100-day, the 21-day, and then we burst through the 100-day after the US CPI numbers. I've just got on here these fib levels. Actually, if you look at the weekly, we're looking at, well, bulls are looking at 120 really, with this breakout of that, the bearish channel really. Upside levels then would be 120.52. That's the halfway point of this year's fall. So key number there, 120.52. And then if you look at the 100-day, the 200-day moving average is then above that 120 level, which is around these August highs, around 122. So maybe a push to get above there, but we're not overbought on the RSI. So interesting, we could get a push higher after this consolidation period. Again, natural for us to see consolidation after such big moves. Positive in a way that we do get consolidation before, and we do hold around these highs, then we can push above higher up to 120. But a lot may depend. We might go back to the domestic story for sterling into some of these numbers on Wednesday, certainly the CPI, and then the fiscal statement on Thursday. A lot going on then in markets. Hopefully that's been of use to you. CPI numbers out of the UK to focus on the fiscal statement, and then a lot of Fed speakers as well to focus on whether they do push back. The expectations are they do push back. So potentially, if there is a surprise, it will be that they are pausing, and they highlight then that the peak rate is potentially below 5%, above 4.6%, but below 5%. And then the dollar trend will be key to watching going forward, whether it's just a correction or the end of the bull market in the dollar remains to be seen. But yeah, please follow us on social media, our daily commentary as well on the website. Good luck out there, and we'll speak to you definitely next time.